Good day to one and all. This is Dr. Sivaram of iknowindices.com. I was giving Tracking Live the Forex Market Together Part 1 webinar today, 19th of October, between 8 and 10 GMT during the European session. And I also committed certain positions based on the market studies, and also I kept the hedge orders in order to limit the risk. And now we will just review the market for the US session start time and also look into that of the data or the trade recommendations and find out how exactly we have to handle the market. So basically, tracking the market with the help of the live market code page on the GMT time frame will be a continuous 24 hours watching, and there is no need to watch the market 24 hours, but instead you can just watch the market during the early and the late part of each of the sessions wherever possible, so that you will be able to clearly understand when you are trading in majors. Now it is 14 GMT, 13:30 GMT the US session starts, so 30 minutes past the start of the US session. And if you look into the of the market here, Euro is showing 12 pips negative net change, and during the European session, Euro was showing positive net change, and GBP was initially showing positive net change, and from there it came down to show the negative net change. Again, it started gaining to 1.23 area and hovering around there. And in the case of yen, it breached the initial low 103.66 and came down, but still it is not recovering, and it is holding and making subdued moves around 103. And in the case of USD yen, the players are known to make the swings during early part of the session. Okay, I'll answer the questions afterwards. So in the case of USD, they made a dip and then they are holding it, and now it is closer to the low. So first of all, we will try to understand those who are not attended part 1 and coming to part 2. I want them to understand how the trading system has to be understood, because when I was giving the part 1 during the European session, many people in the US would not have had the opportunity to attend to this webinar because that will be too early in the morning for them to attend. So for those of you who have joined the webinar now, I like to briefly touch upon what I explained. Later on, you can just view the part 1 of the webinar in the recorded form, then understand the whole thing. Now, my trading system consists of 3 important components, namely the derived forecast. The derived forecast is based on a statistical algorithm, and with which a sequential statistical analysis, with which I'll be giving the forecast for the entire week. On a weekly basis, I am giving the webinar called Asian Session Live Market Analysis. On Mondays, I give and review the forecast on Friday during the webinar time. Then in that, I give the session-wise forecast. The session-wise forecast will be like this. Each day, during the Japanese, European, and the US session, how the market is expected to behave. Now, there is a question with regard to FOMC. I think there is a wrong input with regard to the heading. I think FX Street, when they just done the copy and paste, last time during Tracking the Forex Market Together webinar, FOMC meeting was there. So subsequently, they just copied it and pasted it for this month. And unfortunately, it is on FOMC is on not today, and instead it will be on first week of November. So even though it is given in the title, so I'll be following that of the forecast and then try to recommend the trading. Now here you find the swing and drop is expected to happen during that of the US session. But already they made the drop during that of the European session. Instead of firming up, they just done the firming up little bit and then started making the drop during the late part of the European session. And then subsequently they started gaining in the case of GBP and holding euro at the near the low. During that of the European session, we have seen that GBP was making the drop, euro was holding high. Now you find that GBP is holding near that of 1.23 and euro is holding near that of the low. So this is mainly to make small swings in the case of euro GBP and other European crosses by making contrarian move in the case of euro and GBP and also CHF. CHF, they are holding it without making much of a headway on the up or the downside. So this is how they handle the crosses. So it shows very clearly that the traders find more interesting aspect with regard to euro GBP cross. So the players are also making some quick moves there in order to make some profit. So what they are expected to do now, since they are done the drop during early part of the year session, slowly they are expected to recover, and this firm up they are expected to do it at the end of the US session. And again, they are expected to make a small dip during the start of the Japanese session tomorrow and start gaining it. And tomorrow you have the ECB press conference, and they are expected to, on the interest rate decision, they are expected to again make the slide before that of the ECB conference and start gaining the levels. And then you will come across very visible rise in the case of euro after that of the ECB press conference around 12:30 GMT. So this is how I fine-tune the forecast. So hope you are able to understand. This is the gross forecast. I have given it on 17th. Today we are on 19th. With the help of the market reading, I'll be able to find how exactly the players make specific type of moves during specific sessions. Then we will be able to understand what sort of trades you can do. And that is what I am trying to teach you. So I have given the forecast, and what I have done with the help of the market reading technique, I fine-tune the forecast. The same way I expect you to do it, so that without depending upon me, you will be able to trade on your own. So ultimately, holding hand should be stopped at one point of time, and you should be able to do the trades on your own without any difficulty. That is my basic idea. Now, with regard to the initial lows and the highs set around 3:30 GMT, euro went up above that of the initial high, started making the slide, and the initial low was 1.0974. They breached and came down to 1.0958 and started gaining the level. So this is what the dip they have done it. A brief upward stop and as well as downward stop and making a nominal move of 35 pips in the case of euro. So maximum of 44 pips they have done it. Then in the case of GBP, it has just breached the initial high, went up to 1.2331 and came down and breached the initial low and came down to 1.2278, and then subsequently they just 80, and then subsequently they gained the levels again, now holding around 1.2298, 1.23 area. In the case of USDN, I kept the sell order, but they are not filled it, but they are just hovering below that of the initial low as an intentional move on the downside. And you know that from 104 to 103, slowly they are holding and selling. And you will come across, suddenly a quick drop tomorrow in the case of USD to 102 area, and that is why they are building sell positions, and afterwards they will try to start accumulating around 102.25 and below. And when the traders sell in distress, whatever the sell position they have built up, they will try to buy against that. In the case of USD CHF, they are not breached the low or the high, indicating that they are simply holding it and making only moves in the case of Euro and GBP among the European crosses. In the case of Canadian dollar, they just made a downward stop and below that of 1.3083 and came down to 1.3064, holding below that of the initial low, and they could hover around here and then start making slow slide as an intentional move as they are 10 upward stop. And during that of the early part of the European session, they are expected to make a downward stop and hold there to buy back against their sells. In the case of Australian dollar, they just made a brief downward stop and of 3 pips during that of the Japanese session. Subsequently, they went up. They are not breached the low or the high afterwards. They are simply holding it. So the commodity pairs, they are simply holding. They are focusing on that of the European crosses and also the majors now, and also to some extent the N crosses. The N crosses, they are just making small slide by dropping USD slowly, and tomorrow they will make quick drop by holding low Euro and GBP and also dropping USD and all the three will be showing negative net change. Now we can understand that Euro has made about 8 pips, 9 pips negative net change, and USD is also making negative net change as a contrarian move to make a downward move. Similarly, Euro is showing negative net change, CHF is also showing negative net change. So this way, they are making contrarian move to make a downward move in the case of Euro CHF. But still, all the crosses, they are handling it nominally without much of a move, and they want the traders to follow the charts and just to take the sell as well as buy position in a narrow range, and suddenly they will make a breaching of those levels and try to make big moves from tomorrow. And they are expected to make initial drop and then start gaining the levels after that of the ECB press conference. I'll be giving my spike trade call webinar tomorrow before that of ECB and as well after that of ECB as the position and call, and then subsequently the review and the results out of that. So the drop is over now in the case of Euro and GBP, and they are expected to gain the level. USDN going around closer to that of 103 will trigger the market to make small gains during that of the late US session. Now we will take up. So as I explained that the derived forecast is one. Then afterwards we do the market reading in the 4 majors and 2 commodity pairs. The market reading, we note down the initial lows and the highs around 3:30 GMT and try to compare it to that of the rest of the times of the day during 3 sessions of the day to find out what sort of moves they are trying to do it. And in spite of all the reading, the forecast as well as the market reading technique, sometimes as human we may commit mistakes, or we would have just ignored certain moves, we would have just not noticed that. And in such a situation, the market can go against our expectations. So at that time, we should not become stunned. Instead, we should be able to use it as a trading opportunity. And for that, I give more focus on the trading strategy using the hedge instead of stop. So those of you having account in trading platform having hedging facility, but in the US trading platform, it is not available. And in such a situation, so you have to be opportunity trader. That is, whenever they make subdued moves, don't enter into the market. During the early and the late sessions or during the gap time, when they make a quick upward or a downward stop, and you try to focus on the contra trade or counter trade Then you will be able to see quick profit, immediately keep stop at entry, and then try to maximize the profit. That way, we can avoid the stop being hit and incurring a loss. But in a profit-making position, you can always keep stop at entry so that once it is closed, you will get a better level to enter into the market, and thereby you will be able to continue the trade without losing your mental strength. Only when you continue to see the stops are being filled, you become demoralized and you become abundantly cautious while taking the positions. And so what is more important for you is identify the entry time depending upon the facility available in the trading platform. If the trading platform has got the hedging facility, any level you can buy and any level you can sell, and if you wait with 45 pips limit order in both the hedge as well as the other position, you'll be able to see that during the either way moves of the market, your orders will be filled, and then you'll be able to see that profit is realized. So the trading strategy is really helpful in making either way trades in the market. Now I'll look into the trades what I have taken during the European session and see where exactly we stand. I was telling you that when market was holding near the high, I was expecting that market to form up during the late European session, but they have been simply holding it, not making any headway on the upside. And then afterwards, towards close of the European session, they started making a stride in the case of euro and hedged me. And 1.0960 they hedged, but came down only to 1.0958. If would have used the stop, simply the position would have been closed, and we would have incurred 30 pips loss. Instead, what I did, once it is hedged, I watched for 10 minutes and kept stop at entry, and then subsequently they closed the hedge, and I kept another hedge order 1.0930 and watched, just taking another 30 pips risk. And once they start going above, and now you find that the hedged level, they are not showing a gain, and they are holding high above that, it indicates that it was during the stop and the session start stop and during the gap time stop and they filled or hedged me, and then subsequently I found that they intend to gain the levels. Already they have gained the level in the case of GBP, and in the case of GBP they came down after that of 1.2282, and then subsequently they started gaining the level, so I was not hedged. In the case of yen, I kept the sell order around 103.53 when the 103.66 was the initial low, but they did not go there. They have been holding around 103.45 level, started making the slide from there. So not actually got any position in the case of USD yen. So we should not chase the currency. Instead, we should wait for the next opportunity and enter into the market, so that we'll be able to really find that the players make some specific moves, and if you follow and track their type of moves they are doing, it's easy for you to understand what is going to be the next move. They alternate the extended move with the intentional move, and you try to focus on the extended move to take positions, or wait for the stop-ins to enter into the market, and then during the intentional move book profit using a trailing stop in a profit making position, and also using the trailing take profit order. So that is a way, if you trade, you will find trading becomes really a pleasure, and you will be able to really see that profit is building in your equity. And many of the traders, they think immediately of averaging every 20-30 pips drop in the market. So if 1.0990 had taken a buy position, it has come to 1.0960, take another position. Then if they drop another 30 pips, take another position. Then without their knowledge, for every 30 pips when they average it, then it leads to over trading. And if the market goes against all the three positions, another 20-25 pips, there will be $1,000 erosion in the usable margin, because all the four positions will each will debit 25 pips. So in such a situation, you find that overtrading leads to extension of the account. So you have to avoid that overtrading and focus only on one trade at a given time. And after booking profit, you think of another trade. You'll be able to consistently earn money from that other market. And some people say that with the earned profit, you can risk more. That is a wrong approach. And that is again a gambling tendency. Why should we take excess risk? We can always limit the risk using the hedge order and do either way trades. Suppose the euro has filled the hedge and the hedging is making profit for 30 minutes. Then we understand that they are making an extended downward move in the case of euro before making a rise. Then we find that the new low what they have set is not being breached for 30 minutes in a session. We close the hedge with a profit and keep another hedge order to limit the risk. And once they start gaining the level, we trail the hedge order upward until we are able to keep stop at entry. So we participate in the market moves on either side. We don't get struck if we use the hedge. But if somebody says that if you use hedging, you do not know how to trade, they wanted to really discourage you making money. Nothing more than that. And they simply say that because some of the traders, after hedging, they simply watch the market without taking appropriate trading decision. And they ask their dealers what to do with the hedge position. So then such people are being advised not to use the hedge. It is not that all the people who are able to understand how the hedging has to be used should be discouraged. So how do we decide on the trade? We watch for 30 minutes from the start of the session. And then when the market is near that of the low and not breach the low for 30 minutes from the start of the session. 13:30 is the start of the US session. Up to 14 GMT, we find that euro has not breached the low. So we watch for 30 minutes. And before the end of the early session, we try to commit the position so that we'll be able to really see profit. In the case of euro, already we have position. In the case of GBP also we have position. So we'll carry forward the positions to that of the next session and then continue the trade and try to earn money from there. And see, the platform will discourage you holding the position for more than a day by adding overnight interest. But the interest component might be for a few cents to that of $1. But you think immediately you are losing it. But once you close the position with 1 or 2 pips extra profit, then automatically that is being taken care of. So keep in mind that many discouraging factors are being built up in the trading platform, like that of the hedging facility is not being provided to that of the US clients. And the excess leverage is given to that of the European and other clients. In US, for US clients, the leverage is 1:30 and 1:50. But for that of the European and the Australian clients, they give the hedging facility. I mean, they give the leverage as 1:100, 1:200. Some platforms even offer 1:500. And that is actually detrimental to that of the trader. So the trader immediately thinks that 1:500 means that he can take one position, pay only about 20% of that as the margin. But actually, when the market goes against, that big position will be eroding the equity. More than that of the money paid for holding the position, the loss will be bigger and that will erode the equity. Invariably, what happens when lesser money is taken for the leverage position, the trader is tempted to go in for over trading, thinking that there is adequate usable margin, so one can take more positions. So sometimes the traders take about 4-5 lots together. when the leverage is very, very high. Then later on, when the market goes even 20-30 pips against, they find that usable margin erodes. And also, many of the trading platform, they offered the bonus. And I was telling many of the occasions that if you are being informed that you will be getting the bonus once you open with a fresh account and deposit some money and things like that, and such bonuses will be withdrawn without your knowledge or with a very short notice knowledge whenever you have adverse positions. That is the technique that platform providers apply on their own clients in order to grab the money, because once they withdraw that free bonus what they are given, they simply put the condition that you cannot withdraw the bonus. It can be only used in the trading account, and then subsequently when you have over traded or taken more position thinking that you have got adequate equity, when they withdraw immediately, you find that the usable margin is become very tight and it could attract margin call. Then when you check with the dealer, the broker, they will simply say that no, we withdraw the bonus because you do not know how to trade. Simply they discourage because that person might be holding so many unfavorable positions. Then when they say that you do not know how to trade, that is why we are withdrawing the bonus, that fellow will accept that, yeah, I do not know how to trade. That is why I am caught on the wrong side and lose all the money. And many of the market makers do this particular strategy. And also they give a specific type of movement of, see what you come across in the live market code page, you find the moves are very, very slow. Actually, the moves are very fast. If you find that the update happens every second, the trades happen. And in such a situation, you will come across still the spread between the high and the low will be the same in such quick trading platforms. But you know what happens in some of the market makers platform, they will say that variable spreads. You won't be knowing what is that variable spread. It's simple that whenever there is a downward stop build, for example, we will have the ask at 1.0967. The bid will be 1.0900. 60 pip spread will be seen between the bid and the ask. That is called variable spread. So what the players do is they use a specific type of order to crush the market on the downside so that all the stops will get exposed. And also if you don't even use the stop, your position will be exposed on the margin call, and the platform providers will catch hold of your positions and try to close it. So the variable spread is another risk. And whenever the spread becomes wider, your equity will erode. Take into consideration the other side level. Suppose you have got a buy position, then when the market comes down, it will take that particular position as an adverse position, take away 60 pips for each of the positions, even though the market has only made a dip. And if you try to buy there, they will not fill the order. So these are all the tricks they do, the platform providers. One need to understand. And accordingly, you have to trade. My simple advice will be, it is very difficult to fight against that of the platform providers or to that of the bank and things like that, because it is a network. And all the network people try to sabotage the traders. So if you are interested in continuing trading, then what you have to do is trade in a smart way and try to earn money from the other market, following the intentions of the players. And if you try to follow technicals and fundamentals, it might appear okay, but then subsequently you find when the market reverses, will be vulnerably caught. If you got any question, you can ask me. I'll answer to those questions. Either based on the part 1 or based on the part 2. I'll be willing to answer the questions, or any market related questions we ask, I'll be willing to answer here. See, from that of last day, 31st of October, you find that daylight saving system will be off in Europe. From first week of November, US also will switch over from that of daylight saving system to the standard time. Then the market timings will change accordingly. We have another 1 week to go. Afterwards, during that of the Asian session live market analysis, I'll give you the timings of the new market. Timings of the changed market scenario depending upon the daylight saving concept. So these are all the types of market moves the players make, that they make less than 30 minutes some moves, which are all quick moves in order to just give the knee-jerk reactions to that of the traders. We call it sometimes as the dips or moves, and they are all mainly done in order to attract the trailing stops and also to hit the stops. So you know that when they quickly make a drop, but what you see here in the code page is different from that of the trading platform. In the trading platform, suddenly you will find that level will be withdrawing very frequently on the lower side. Then immediately, quickly come up. In that case, if you keep a trailing stop of 10 pips, it will be attracted to the higher side, and when they make a dip of 10 pips, it will be filled. So whenever you find a technology is being developed in order to facilitate the traders, the platform providers make the moves with the help of the dealers in the market. And they simply say that we don't interfere with it of the trading platform. But I have found that I have got very good feedback from that of the most of the platforms in the world from my clients. And every platform, they try to cheat their clients. They may simply say that we are all regulated and we don't manipulate and we don't do this and that and things like that. But all are manipulators. There is no exception. And what they do is they can only earn from their own clients. They cannot earn from the market. If they know how to trade and earn from the market, they can trade on their own and earn. There is no need of attracting the traders to their account and open an account and giving bonus, etc. And even the regulated trading platform providers, they just make it automatic for you. The fees go to the bank directly. Once they find that you are earning profit consistently, they immediately give it to the dealer, ask them to make some recode, etc. for your trading account. So the next strategy, what I suggest to my clients, will be don't hold that account for more than 2 months in a trading platform. Then you continue to shift from one platform to another platform. Probably they will also try to develop a new method of trapping such traders also. So we have to be over smart, and we have to understand that the platform providers, the players, brokers, banks, all are willing to grab our money. But still, there is a great trading opportunity available in the market, and provided you know how to do it. It is something like driving a vehicle in a highly unregulated traffic condition. And in India, we used to call it as Calcutta. There, the traffic was supposed to be very, very unregulated. And you know that when you are going on the right track, and it will appear as if you are going on the wrong track, because many of the vehicles might come in the wrong direction. And also, suddenly people can cross the road at any region without the zebra crossing, etc. And the various type of movement you could come across, with small moving vehicles to fast moving vehicles, etc. But still, if you go there, you find lesser number of accidents because everybody is trained to drive in such a condition. So they become doubly alert and continue to drive and reach destinations, especially the taxi drivers. So you have to understand that in any condition, you will be able to trade provided you understand the trick of earning money from that of the players. There is a question from Bren. Is the net change difference of any importance as the pip difference between the high and the low when deciding to enter? Okay, as far as the net change is concerned, which is from that of the previous day close. Okay, so now I was talking to you during the European session. Euro was showing a positive net change from that of yesterday US session close. And today during the US session, you find Euro is 11 pips lower than that of yesterday's close. That is what the pip indicate. Especially this net change is provided for the banks not to reach more than 150 pips net change on the upside or on the downside. They are all the gentleman agreement and with which you come across the market is making the move. So if you follow that, once it reaches 150, on certain extreme days, whenever the market really requires some regulation, you might come across Euro and GBP making about 200, 250 pips net change. But end of the day, if you watch, they will bring it to 150 pips net change level and close the market. So they give some leverage for want of liquidity and then subsequently regulate it. So in that gap, the banks try to take the advantage and try to manipulate and earn money in the form of telling that exchange that there is want of volume. So you find everywhere the trick is being played, and the net change is only to indicate that how much the market has moved from that of yesterday's close. As far as our trading decisions are concerned, we have seen the initial low in the case of Euro, 1.0977, and then came down to 1.0958 during start of the US session, and during the gap time start of the US session. And then from that time onwards, they are not breached the low. Once they stop cutting the new low, even though they are holding below that of the initial low, we can take a buy and keep hedge order 30 pips below. And once they start gaining the level slowly, and provided you find that session wherein they are going to make a distinct rise, then at that time you can take a buy. Otherwise, what will happen? They will be gaining the level in the case of GBP now, but hold Euro. So if you take position in Euro, you may not be able to immediately get profit. Whereas if you take position in GBP, they could gain the level. In order to drop Euro GBP cross, they will quickly gain the level in the case of GBP. They are handling it now. GBP is showing positive net change, Euro is showing negative net change. I was telling you during the European session, Euro was showing positive net change and GBP was showing negative net change. This will indicate how exactly they are making contrarian move, or the US dollar gaining or the US dollar weakening moves in the market. Now if you look into that, Euro is showing US dollar gaining move, USD is showing the US dollar weakening move, GBP is showing US dollar weakening move, CHF is showing US dollar weakening move, Canadian dollar is showing US dollar weakening move, Australian dollar is showing US dollar weakening move. So accepting Euro, similarly during that of the European session, excepting GBP, all other currencies were showing USD weakening move. This is how they bring in the difference, and that makes the crosses to make big moves in the market. So invariably what they do is the analyst or the other banks, etc., they put their report that due to sudden increase in the volume in cross, the major has made a big move against the expectations. But actually, the players make moves in the majors, which is reflected in the case of crosses. And once the banks say that the crosses are independent than that of the majors, then what happens? The traders think that okay, there is going to be a US data release, then it is better to avoid US dollar related currency. Instead, we go in for a Euro GBP cross so that it will be unaffected during the data release. That is what they take the position. But what they do is they make the USD gaining or the USD weakening move during that of the data release time. Then subsequently they change to that of the contrarian move. How they have just done the contrarian move, if you notice from that of the European to US session, they made a positive net change in the case of Euro during European session, and now it has become negative. They made negative net change in the case of GBP during European session, now it becomes positive. This is how they make the move. Thereby, we find the crosses are handled. So, since the volume is relatively low, that is why they are not handling in a big way the majors and they are handling the crosses. Wherever the positions are committed by the traders, they try to make the moves in the market. So they are opportunistic trader. When the players are opportunistic trader, we should also be opportunistic trader. When the traders commit positions in majors, they handle the majors. When the traders commit more positions in crosses, they handle the crosses and then come to the majors. Ultimately, they want money. They want money other than money. They don't want anything. They are not interested in showing a higher level or lower level in any specific currency. They are traders. They just enter and exit out of the currency. And all the reserves are kept in US dollar. That is how the players do it in the market. That is why you come across US dollar suddenly wake up like a sleeping giant getting up, and you find everybody started talking about the US dollar is going to gain, US dollar is going to gain, and create an euphoric condition in the market. Any level you sell any currency, you will be able to book profit. Then immediately all the traders will try to commit more positions in order to earn back the last money. And then the players buy everything and quickly reverse the market, telling some stories or say that Fed is going to increase the rate or US election is going to be of this nature, etc. They simply give the message and say that it is already built in the pricing, and then start making the big moves and trap the traders. Ultimately, they want to trap the traders. So whatever the sentiment they create, don't blindly follow. Try to read the hidden agenda of the players. Then you will be able to learn. So this is what I've given it as an explanation. If it is hedged, watch for 10 to 30 minutes. If the hedging is not making profit, understand it was filled during false move or the stop it or extended move. Then close the hedge with a loss or with stop at entry and keep another hedge order of 10 to 15 pips or 30 pips if equity permits away. And then when the market moves, favor, immediately move the hedge order to the original positions. So that again you take risk only for 30 pips. Once the position makes profit, you keep stop at entry and remove the hedge order. Then the purpose of using the hedge is limited only to that. Then afterwards, use a trailing stop in profit making position and maximize the profit using the take profit order on a trailing basis, and the trailing stop also a manual trailing. So since the players or the platform providers attract the trailing stop, because once they make a quick upward move and then dip, then immediately the trailing stop goes up and it does not come down when the market dips. So they are able to attract the trailing stop and fill. So what do you have to do? Use manual trailing stop. Manually you move it, keeping away from the market so that they will not be able to fill it. So if they think they are smarter, you have to outsmart them. Because it is your money, you have to protect it. So the same trade we will continue here during the US session. So Euro 1.0990 a buy with a hedge order at 1.0930 now. And once they stop cutting the new low and start gaining the level, we can slowly trail the hedge order upward. And in the case of GBP, now the position is slowly making profit the buy side, and you can keep stop at entry once they go above that of the high 1.2331, and immediately keep stop at entry here. Start trailing upward and trail the take profit order also upward as long as they go. So if you have about 15-20 pips above the market, a trailing take profit order, 15-20 pips below that of the market, a trailing stop to protect the minimal profit. Then you find as they go up, you can manually move the trailing stop as well as trailing take profit order and maximize the profit. So it is not simply the risk aversion alone is the trading strategy. You should also develop the trading strategy to maximize the profit, so that in a single trade, it is a hard-earned money. It's a great opportunity. You find that the position start making profit, and then you should be able to really capture the profit when it is available. And when you have a bad trade previously, and in that bad trade, you could have just earned about 30 pips, but you become greedy. You expected 100 pips profit, and suddenly the market has reversed. So that will be giving an impression to that mind that when the profit is seen, immediately close the position with a profit. Then what happens? You tend to close it with 5-10 pips profit. Afterwards, the going becomes very good, but you don't have a position to put profit. So in order to eliminate the influence of greed, you have to use the trading strategy in profit-making position also. So on the downside, you use the hedge order to limit the risk against your panic condition. Similarly, you have to limit the risk against your greed by using the trading strategy. And Constantine as is this strategy suitable only for small trading movements below 30 pips? How would you suggest to hunt trading movements 40 pips and above? No, this is the trading strategy. You can use it even during any intentional move for that matter. There are many days, especially on Mondays and Fridays, you will find a lot of traders who are open position, they wish to close the positions. Then at that time, the players will make slowly the intentional move for 100 to 150 pips net change level. So slowly they will cut the new low. Slowly they will cut the new low and come down. At that time, you can maximize the profit to 150 pips. The same method, no change, so that there is no question of taking an appropriate decision, whether it is a swing trade or a position trade and things like that. You continue to trade either way. When they drop, okay, hedge and book profit in the hedge. When they rise, okay, fine, I'll keep stop at entry and book profit in the buy. Then again, wait for 30 minutes before taking the new position, or wait for the new session and follow the forecast and then try to fine-tune the entry and enter into the market. So if it is not hedged and showing profit, grab the profit using the trailing stop. If they hedge you, then do either way trades. So you have a total solution on either side moves of the market. It is not that you have about 70% solution or 80% solution. You have 100% solution for your trading. So understand, only the trading strategy can make you to consistently earn money from the other market. It is not the forecast. Many people think that, okay, he is giving a good forecast, the other person is giving a forecast, and his signals are good and things like that. Consistently, no signal will be 100% true all the time. And if he may claim, or anybody can claim that it can be 90% or 95%, even I do claim my forecast is giving a results of about 90 to 95%, but still If you commit a trade in 5% of the wrong trade, how do we manage? We need to have a solution for that. That is what I'm giving along with the forecast, the trading strategy. So the forecast, then market reading to fine tune the trading, and then finally you go in for the trading strategy. Now, they have made the cut of the earlier low 1.0958. They just breached it and formed the new low 1.0955. So you have to see whether it is a brief stop and before making a rise. Because in the case of GBP, they are not making a drop. So this drop is mainly to make a downward stop in the case of Euro GBP cross. That is why they just cut that. After 14 GMT, when they are cutting the low, only in the case of Euro, not at the currency, then it is a downward stop in the case of Euro GBP cross. For that, they just firm up a little bit GBP, hold, and then make a brief downward stop in Euro, which will give that feel to the traders who have gone long in the case of Euro GBP. Because many of the traders have got long position in Euro GBP because they know very well GBP, unless and otherwise we find a solution for the British exit, it is not going to rise. That is that sentiment they created. So many have taken the position in the case of Euro GBP cross. See how cleverly the players are making downward stop and by making such moves before making a big rise in the case of GBP and also Euro. So they are stop hunters. So when they are stop hunters, you have to be smart enough to avoid getting stopped out. See, from 1.0958, they came down to 55 and holding it. And once they stopped cutting the new low, understand it was a brief downward stop and for 30 minutes and then start reversing the market. Is there any other question? If there is a question, then I can answer those questions. Otherwise, I'll just wind up the webinar. So keep in mind that the three components are equally important. So don't think that with the forecast we will be able to earn. So simply subscribing for the forecast may not be able to give you the money, provided you understand how the market reading has to be done and how the trading strategy has to be used. Then always keep in mind, earlier in the late sessions they handle the majors. At that time you enter into the market in the majors, and during the mid session they handle the crosses. At that time you take positions in the crosses so that quickly you will be able to book profit. Then identify the type of moves. Above that of the high and below that of the low, they make stop and for about 15 to 25 pips. False move, they go up to that of the high and reverse, or up to that of the low and reverse. And that they do it before that of the data release and also during that of the gap time. That is considered as a false move. Both are quick moves. And also extended move, they just breach the high and stay there above for more than 30 minutes up to 2 hours and then reverse and make the intentional move on the downside. Otherwise, they breach the low and stay there below that low for more than 30 minutes up to 2 hours and reverse and rise the market. So that is an extended move on the downside before making an intentional move on the upside. So intentional move can only sustain for 2 sessions and the start of the 3rd session. And don't think that whenever they rise Euro or GBP, they will continuously rise endlessly for several days. It is not. So once they continuously rise, all traders will take buy positions. So the players are not willing to give profit to them. Instead, suddenly they will use somebody to make a speech or somebody to make a breakout news or rumor they create if nobody is willing to speak, and then make a sudden drop in the market and hit all the stops of such traders. Especially breakout traders keep wide stops. So you know that when it has gone above 1.100, they have taken a buy and then just to keep a wide stop below that of the low, they will come and hit the stops before making a rise. This is what they do every time. So planning your trades wherein you only limit the risk and maximize the profit. My contact details are given here. My website address is iknowindices.com, i-knowindices.com. I'm Dr. Sivaraman, basically a professor, retired professor, and during my postdoctoral work, I developed the algorithm with which I am giving the forecast for the past 20 years. And this is my email ID. And I find that those who have started with the forecast and other things way back to 1997, I hardly find anybody who is still continuing giving the forecast. So invariably, they find that the technicals and fundamentals are not working. They try to follow certain methods and find that which is not working during some extreme moves in the market. So ultimately, you have to find out a method which can work in any market condition. My chat ID, phone numbers are all given. So tomorrow I'll come back and give the webinar before and after that of the ECB press conference. There is a question from them. Is the swing the same as consolidation, or the swing a wider move? A swing near that of the high or near that of the low is of the same nature, about 5-10 pips, sometimes 2-3 pips, sometimes 20-30 pips. So it is the amplitude of the swing may vary. It is like the waves of the sound, etc. But ultimately, they are all referred as swing. A bigger swing, smaller swing, you can probably call it. So I take this opportunity to thank FX Street for the facilities provided to present the webinar. And for those of you who are interested, join the webinar to learn the tricks of the players so that you can avoid getting hurt again and again. So try to learn the trading strategy, give importance to that, then give equal importance to that of the forecast, and try to eliminate the uncertainty before entering into the market. Don't try to speculate 100%. Then that might bring in more fear to you, and which you may not be able to accept. So especially when you have a high level of greed, the panic condition will also be very high for such persons. And invariably that shows the imbalanced condition of the brain taking decisions. So avoid over trading. That will solve many of your trading problems. Wish you all the best. See you tomorrow. Come up with a new forecast and also the concepts on trading. Thank you one and all. Wish you all happy trading.